Welcome, everyone. This is Jeff Bish, president of MarketGauge.com, and it's with great pleasure that we get to present, along with Mish, the anatomy of a perfect swing trade. The idea here is to learn how to read the market, anticipate its swings, and ride them for maximum profit under the context of swing trading. Now, in order to become more profitable, MarketGauge tries to get you to focus on some really core ingredients to success in trading. The first of which is that your trading strategy should be simple. And the reason it should be simple is because simplicity leads to better and more consistent execution. Now, you're going to hear a lot about consistency during this presentation because consistency in trading is so critical. The second thing that's absolutely essential to be successful in trading is to understand how to manage your risk or trade your risk. And simply put, you want your winning trades to make a lot more than your losing trades. And the reason for that, at its core, is because if you do that, you don't have to be right nearly as often. And I don't know about you, but I'd much rather sit down every day in front of the trading terminal and know that, you know what, if I'm right half the time, I can still make a lot of money, as opposed to having the stress of thinking I got to be right 70 or 80% of the time. Now, the other thing that is important in success in trading is to have realistic expectations. And these need to be expectations not only in terms of your trades, but they need to be expectations in terms of emotionally. You have to believe in the trades that you're taking. All right, that comes back to having a system and consistency so that you believe in what you're doing and you know when you're doing it right and you know when you're doing it wrong. And finally, if you're so fortunate enough to find a mentor, is another extremely important way to become successful. Now, every trader is pretty much looking for the same thing. We may get there in slightly different ways, but when we boil it down, we all want to have an equity curve that looks like the equity curve here. So what you're looking at here is a model portfolio. In red is the model portfolio, in blue is the S&P, just so you can get a sense of how the model portfolio has traded relative to the S&P, but also, and I would say more importantly, to see the consistency in its trend. Okay? When I say consistency, there's going to be times where it levels out and times when it accelerates higher. But if you can have a equity curve that's this smooth, and when I say smooth, an equity curve that will go like this would not be smooth. Now, it may get you to the same place. Let's make it happen as such. But the problem with an equity curve that's that volatile is that traders will tend to bail out on their system after big drawdowns. They quit. They never make it to the end. All right? So a smooth equity curve means consistent income. Nobody will argue with that. Less stress. Most people are after that. And certainly it'll lead to more enjoyable trading. So that's really what we're after. And when we say consistency, and when Mish is walking you through her approach, and when we talk about ATRs, it's all because we're trying to get to this. All right, so with that, I'm going to let Mish take over, and I will be back to help with questions and a few other things later in the presentation. So it's all yours, Mish.
Okay, just want to make sure I'm showing the right screen. Okay, so hi again, everybody. Those of you who've come in since we began, welcome. Good evening, good morning, wherever you are, whatever part of the world you're in. I have a lot to cover with you tonight, as I always do. The greatest challenge is to take a body of knowledge that goes over a tremendous period of time and simplify it down to its most salient features so that you can walk away and feel like you've really learned something from me today. And so this webinar specifically is meant to give you a good foundational instruction on how I go through my trading process. And we're going to be focusing on the mini swing and the swing trade, and hopefully what you'll see is certain parameters that I look for that make it almost darn perfect in terms of the entry. And then, of course, also extremely important is when to get out, whether it be partially or fully. And with this, the goal is to show you that over and over and over again, as you saw in the equity curve, and thank you, Jeff, for showing that you will actually consistently make 2 times what your initial risk is. And because I try to keep it really simple, there are people that go through all different types of fancy diagnoses and calculations. I like to keep it relatively easy so that anybody can feel they have enough information to really start trading relatively quickly after they've been in my webinar. And if they're already trading, as I see many, many, many of you tonight are, to improve your trading very quickly after the webinar. Now, I just want to say before I go on, I want to tell you that questions, I know there'll be questions coming in. I tend to talk fast. Once I get into a role, I will try to slow it down. I will try to be very fundamental and stick to the points of what I'm trying to really give you tonight. But your questions will not be answered until the end, because what happens is I get kind of scattered, and you don't want that. I want to stick to my point. So let's begin. We're going to talk now about finding the perfect swing trade. Now, I did see that a lot of you are familiar with me, and a lot of you are also experienced traders, so you may have heard this before. But I think that you can never hear it enough, just like I don't think I can say it enough, even for the own affirmation from myself. So essentially, I like to really compare this to driving in a car. When you're in a car, if you don't know where you're going to get lost. So what do you need? You need a road map. These days, again, just like point and figure charts are archaic, so are road maps basically. Everybody's got Google Maps or some kind of navigation system in their car. For me in the market, I use phases. Phases are very specific. We're going to go through them in a moment. But when you know what phase not only the overall market is in, whether it be the 4 indices, but the individual sectors and groups, the individual instruments. I saw some of you like to trade Forex. It applies to that. It applies to futures. It applies to it all. It always is good to know, well, not just good to know, extremely important to know what the phase of that instrument is in, because when you do, then you can make certain alterations to your trading style. If you're new, then if you're getting involved for the first time, it still matters to know what the market condition is and what phase it is, because that's going to tell you, gee, maybe I should be learning how to become a day trader because market conditions are choppy right now. Or we're getting little bursts of momentum, but they're not sustaining, so what I call the mini swing, which is what we're going to talk a lot about today. Or things are really trending, and I want to become more of a swing trader. Market's going straight up. Maybe I want to have a long bias. Market is chopping around and going down. Maybe I want to have a short bias. But all these questions are extremely important to ask oneself. I do it on a daily basis. Those of you who read my daily know that I'm going through these phases every single day. So let's look at what the 6 market phases are. Before this webinar, Jeff and I did 3 short videos that we sent out with the email. You may or may not have listened to them, but I went through the actual phases a little bit, and so I'm going to do somewhat of a repeat, not necessarily as in depth, but enough to at least give you an idea. So one of the things that I love the most about everything in the markets is that, like life, it's cyclical. Goes around in a circle. We've got a clockwise circle here. So we have bullish. That is the strongest market phase. But of course, as we know, in nature, things start to deteriorate. And when they do, we will see a market go from a bullish phase into a warning phase. Since 2013, 2014, we've pretty much have stayed between bullish and warning phases in the market. Things have been pretty good. But if we go back just a little bit in time, we know that things deteriorated very quickly into a distribution phase, where we eventually got into a bearish phase where we sat horribly throughout the end of 2007, 2008, when we finally started to peak, bottom in March of 2009, and then, as everything in nature does, starts to recover. And then as things start to really accelerate in their recovery, we go to an accumulation, and then we are back into a bullish phase. So 6 places to be, and you can have all 6 phases represented in the market at the same time, depending on what it is that you're looking at. So what makes that so cool is that, let's say you're a person who just likes to go short, and I know people, I don't try to make any commentary on their mental condition, but they just like to go short. They're always negative. And then I know other people who just want to be long. So you can find things in a bearish phase or things that are deteriorating to go short if that's what you like, just as you can always, no matter what's going on, find things that are actually accelerating and are starting to go up. And what we use to determine these phases, 2 simple moving averages. What that means is that, as I told you before, bells and whistles, I've got them all. I can show you every type of technical analysis known to mankind, plus my husband, Keith Schneider, who's also our partner, and Jeff and I, actually the 3 of us, I've been married to Keith for 23 years, and we met Jeff just right before we got married, so really the 3 of us have sort of been married for 23 years. The 2 of them have spent many, many years developing incredible software with unbelievable stuff. But when truth be told, really all you need is to understand a couple of things about what I'm about to tell you. One is what a 50-day moving average is. 2 is what a 200-day moving average is. And with those 2 moving averages, and those are, I saw a couple of you have just started trading right now, within the last 3 months, is once you can identify these 2 moving averages, where they are in relation to one another, is the 50 on top of the 200, is the 50 below the 200, then how they are sloped. Are they sloped up? Are they sloped down? Are they neutral? And then where the price is relative to the 50 and the 200-day moving averages, you can say pretty much, I've got it. I know where I want to begin. So I'm going to go through a lot of real examples, but in a bullish phase, what you've got is a 50 and a 200. The 50 is above the 200. In a very strong bullish phase, you have an upward slope in both moving averages, and you want the price to be above the 50. But since we're going to talk a lot about risk, because I am really all about risk, if your price is all the way up here, does that sound like a good risk? Yeah, we could be in a bull trend and it could be extremely strong. But if you know that your 50-day moving average is all the way down here, is that a trade you want to avoid? Yes. But if you also have a situation where something is just breaking out over the 50 and it's in a bullish phase and you've got a very tight risk against that moving average, you're golden. That's about as close to a perfect swing trade as I can imagine. So let's take a look at the spiders right now. This is the S&P 500, and actually, of all the indices right now, it has been the strongest. This does not reflect today. Actually, today it came very close to the high and closed just a little bit higher than where it was yesterday, when this chart was made. But more importantly, let's take a look and see what's happened since the fall of 2013 into where we are now in the spring of 2014. Here's your 50. So on all my charts, you'll see my 50-day moving average depicted in blue. Here's your 200. In all my charts, you will see the 200-day moving average depicted in green. This light blue or cyan, that's my 10-day moving average. I use it. I'm not going to focus on it so much tonight. But what I am going to show you is that just using a 50-day moving average, back in, I guess this was probably October 2013, we had broken down under that 50, went into what I showed you was a warning phase. So a warning phase, very simply put, means the 50 is still over the 200, but the price has broken below the 50. Once you get that warning phase and it goes back over the 50, that's very often when you have the opportunity to have your tightest risk. So you see, when I say price near the 50-day moving average, that was one opportunity where you caught a tremendous move up. Now, with a longer term type swing trade, when you get a trending market like we've had, and this is some of the most exciting time to be learning how to trade, because we have had a really great trending market with opportunities to learn how to employ some of the other phases and some of the other strategies, but always the opportunity to eventually figure out where to buy the correction when it starts to come back. If you had just followed the 50-day moving average, it wouldn't have been until January of this year where it broke that you got back into its first warning phase. So just to show you, just knowing 50 and 200-day moving averages in phase, your entry price would have been somewhere, let's say, around 168. Your exit price, when it finally broke down under the 50, might have been around 181. That's a really nice trade in the S&P 500. But more importantly, just looking at where we are now, we went through another correction in February. We came back through the 50-day moving average. In the beginning of February, you had another one of those unbelievable opportunities. And again, if you were following the 50, you'd still be in this, and you'd still be long, and you'd be a very happy camper. So you might say, oh, that just sounds way too simple. How could that be? Well, like I said, I think especially in this day and age, when there's so much information coming at you, and I was actually kind of surprised how many of you said you don't use Twitter at all. And I'm not judging that. Trust me, I'm not judging that, because I am like an addict on Twitter. I get all my news that way. Obviously, a lot of people follow me. I have about 4,400 followers on my free service, so I'm constantly talking with people. But when life can get so complicated, not just with the markets, with the amount of information and all the different types of technical analyses and all the talking heads on TV and yada, 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 really basically it's the simplest that you want to stick to, and you want to shut out all that noise. So this is a quote from a very, very good customer of ours who has been with us in Market Gauge for a long time. I know he doesn't mind me telling you that he is a cardiologist, and he has a sizable portfolio account. And what he has done, let's see if I can spell this correctly. What he has done, and this is his quote, was that he took all the money that he had in his retirement accounts, and he was using a financial advisor. He has taken that all from the advisor, and he is actually doing every single investment himself. And of course, you can see that he's saying he's using 6 or 7 classes of investments. We're not going to talk about asset classes and investments and really diversifying the portfolio tonight. Obviously, that's something that we do. And that's how we wind up having such a smooth equity curve. But more importantly, this guy who works on people's hearts, who is a very busy man, is trading his own money. So that's going to answer a question right away that a lot of you are probably saying to yourself, which is, I can't sit in front of a screen all day. This gentleman certainly does not. Okay, so we talked about phases. Yes, I definitely want to know what phase the instrument that I'm interested in is at. Is it bullish? Is it warning? Is it bearish? Is it recovering? Is it accumulating, etc.? And that is simple, and if you understand after tonight basically what we like to risk, as I promised you, that would kind of be enough. But I'm going to give you a little bit more information, especially since some of you have more experience than just starting out as a trader. So I also look at low-risk trades using short-term price patterns. And what that means is I look at certain chart patterns on a daily basis and on an intraday basis that helps me make the best decision. What is the best decision? The best decision is the decision that gives us the lowest risk. So I want to know if my charts are set up on a daily and intraday basis so that I can time my way in against a moving average. As I showed you before, that would be the most perfect trade. Where my stop is going to be. A tremendous fallacy is that the more you risk, the more you make. Oh, that is so wrong. Actually, it is exactly the opposite. The least amount of risk you have, and if you understand how to hold on to winners, the more you're going to make, and I'm going to show you some real great examples of that. I'm also going to talk to you tonight about inside days. That happens to be one of my favorite patterns. What is an inside day? Real quick, I'll show you. This is, let's say, Tuesday. This is the range of Tuesday, right? Here's your high and here's your low. Here's Wednesday. Sorry, this pen is not the easiest to control. This range is Wednesday. High, low. See this? Inside the range of Tuesday. That's an inside day. What do I like better than an inside day? 2 inside days. That happens a lot too. That would mean the third day, Thursday, would be inside the second day, which is inside the third day. What does that tell you? There's a pause in the action. That means that traders are indecisive about the next direction of that particular instrument. So that also means that when that range breaks, typically you're going to get very, very good follow through. Now, on an intraday basis, we at Market Gauge are famous for opening range formula. This is something that not only do we talk about, teach, use for day trading, mini swing trading, and swing trading, and I am basically religious about it, but it is really stemmed a little history from the floor days back in the futures exchange. Even though I started out in coffee, sugar, and cocoa, most of the markets back in the day, and futures exchanges are still big somewhat in Chicago, but obviously with electronic trading things have changed a lot. But back in the day, they would open up month by month by month, and so you would get an initial range when January opened, February, March, etc. And I was mostly in crude oil for about 7 years. Then everything would reopen. On the reopening, whatever happened in the first several minutes would then, if follow through above or below, you would get actually some good follow through. Now, we've done a lot of research that statistically the range of most instruments are made in the first 30 minutes, which means that you get a statistical edge if it breaks out over the 30-minute or if it breaks down under the 30-minute. So you put all this together, phase, chart patterns, let's say inside day, and a 30-minute setup with good risk, and you are really good to go. So I just want to backtrack here a little bit and talk to you about the evening watch list. And the reason why I want to tell you is that you might be sitting there going, oh my God, all right, she's giving me all this information, but how the heck am I ever going to find, there's hundreds and hundreds of stocks and, tons of futures. How am I ever going to figure out what to trade? So I narrow it down for you. I have, as I told you before, I have incredible, sophisticated tools that have been created with the vision of Jeff and Keith, and also, using some pretty outstanding programmers that we've known through the years. And what I do is I spend every afternoon after the market closes scanning a lot of stuff. And what I do is I cherry pick into 6 different categories what I think are the best setups for the next day. I use the phase, the short-term trading pattern. In fact, one of the setups is a phase change. And then I give you that evening watch list every day if you are a subscriber of mine. And then in the morning, I fine-tune it even more based on how I see the market is going to open. And then throughout the day, I let you know what I'm trading, what I'm seeing, etc. I do it through Twitter, which is why those of you who are unfamiliar with Twitter, even if you never tweet anybody in your life, if you were working with me, it's good to actually join Twitter just to have a private service with me, but I also do it on a text message. So this way, I am looking at all this stuff myself. I am not teaching you something that I don't employ every single day of my life, and that is why I am successful. So just to show you what it kind of looks like, let's say you don't want to use Twitter, you just want to rely on your smart device, whether it be your iPhone or your Samsung Galaxy or your iPhone, which is what this is. This is an example of a real thing that happens, and this is how specific I get with you. And I'm showing you this because I think it's important for you to understand that I don't just throw you out there with this information, but I handhold it for you every day. So I always start with these words: for the portfolio. That's our model portfolio that you saw before. We bought TXT, which is Textron, for a swing trade. I tell you what the average true range is. I will get to that momentarily. I tell you where I was filled and how many shares I bought on the basis of a $100,000 account. So those of you who are cringing right now and saying, I don't have 100,000, I just use 100,000 because it's such a nice, clean, round number. Obviously, if you're trading with 25, you divide it by a quarter. If you're trading with 250, you times it by 2.5. Then I tell you what the stop is. Okay, so that's something that I do every single day. And by the way, that's really helped me too to be that specific. Because in essence, you know what this becomes? A trading plan. If I bought Textron for a swing trade and I'm tempted to get out 10 minutes later, I have to go back and be honest with myself and say, well, why the heck did I buy it for a swing trade to begin with? Let's stick to the plan. So now that we see how we set up and the type of stuff I'm looking for and how I kind of cherry pick it and dwindle it down for not only myself, because everything that I give to you, I trade myself in our hedge fund, but what's really important is to understand that we use what we call the 225% formula. So it's one thing to get in. It's very easy to press the buy button or the sell button. In fact, people can be trigger happy, as we know in this business. What isn't so easy, besides understanding what your risk is, and then sticking to that risk if you get stopped out, is to understand where it's time for you to take some profit. We are driven by our emotions, but we'll get back to that later. This goes a long way to actually take your emotions out of the equation. So essentially what we do is we try to make our risk versus our reward such that we take our profits very quickly. And so what happens is, even if we are actually losing money some of the time, when we get it right, which is more than half the time, we are going to way more make than what we've lost. And when we take some initial profit off the table, we have a tail that we can really ride that trend. So I am all about risk. Maybe it's because I'm a woman. Maybe it's just because I've been doing this for 30 years. Maybe it's because when I was down on the commodities exchange, I saw too many guys literally being carried out after taking all their money and just being really stupid. I mean, there's no better word than that, stupid, about how to trade it. So this is extremely important. I never do any trade without the first question is, how much am I willing to lose on this trade? It's kind of a little bit different way of thinking. Not how much do I think I'm going to make, but how much am I willing to lose? And if you understand that most successful traders really know this relationship between their winners and losers, then you're well on the way to be able to look at this game realistically. This market doesn't owe you jack. People seem to think in this country that all they have to do is open up an account and the stock market owes them. Yes, it's the greatest investment over time that there is. Let's face it, you're not getting any money in a bank on interest. If you bought real estate in 2006, you probably either had been underwater or finally maybe now coming back to break even. But the stock market goes up, up, up. Sounds so easy, right? But we also know that when it takes a tumble, you can get killed. So this avoids all of that. And so this system basically tells you how to make 2 times or more of what your initial risk is, and also make way, way more than that when you're right than when you're wrong. And you don't even have to be right more than 40% of the time. You don't even have to be right, if you read Van Tharp's work, more than 30% of the time. The point is that when you're wrong, you cut the losses fast, and when you're right, you let them ride. I always think it's so interesting that psychologically people are actually more afraid of success than they are of failure. That is a real human condition, and that's something that really will haunt you in trading. So for example, when something starts going your way, you get out. Oh my God, I'm making money. I can't believe it. Ooh, this is great. I better get out because it's going to go against me, right? I mean, haven't we all been there? Whereas converse is, crap, it's going down. It's going down. Well, if I just sit here long enough, eventually it's going to go up. Oh my God, that is so perverse. It's completely the opposite. All right, so let's talk a little bit here. I'm getting yes, 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 true, true, true. Good, because you're the people I'm talking to. All right, so 225% formula. What does that mean? Let's not get too bogged down on titles. It's very simple. So essentially, looking at it through words, and I don't really like reading a lot of stuff on a slide, so I'm going to show you real examples, and you'll have an opportunity to take some notes based on those examples of what I'm talking about. But you find out what your risk is. So remember I said I always go into a trade knowing how much I'm willing to lose based on phase, daily position, and I risk what I consider to be about half of what the range of that particular instrument is. We will get back to that. Then as soon as I get to half of the range of that particular instrument in profit, I will immediately take some off on a mini swing trade, by the way. I'm talking mini swing trade here, and then immediately go to a no loss stop. So what have I done in essence is I've caught that initial momentum. Again, statistically, if a range of something is $1, there's a good chance it's going to go up 50 cents from where you initially got in. So you have a very good shot of taking money off the table immediately. Psychologically, that's very helpful, especially for new traders. Go to a no-loss stop. Now you feel very comfortable. Then when you get to 3 times what your initial risk is, you take a little bit more off. And if things are going well, you can take out the whole thing at that point, or you can leave a tail and then get some momentum to the upside or downside depending on the direction. So here it is written a little bit more in an equation. So let's talk about ATR. I always get like 5 gazillion questions on ATR. It's, to me, extremely important because just like we all, some of you here tonight, you know, I see where we have hundreds of people in the room tonight. You all have different personalities. And so does every instrument that trades have a different personality. We know that by looking not only at things like volume, and obviously where the phase is, but we know that by looking at the range of any particular instrument. It's a great measure of an instrument's personality, or a measure of its volatility is another way to put it. So what does ATR mean? It means average true range. And basically what that means is that over the course of a period of days, whatever the high-low is, you calculate the difference, and then you divide it by the amount of days that you're looking at, just like you did in junior high school math or middle school math, and you get an average. I use a 10-day average. There are plenty of platforms out there that will calculate the average true range for you, but if you have to sit there and do it with your calculator, I recommend you would do it over the course of 3 days, and you get a pretty fair judge. So let's talk about, let's say something has a range of $1. Lots and lots of instruments have $1 range a day. So when I put on the trade, I really, let's say, only want to risk about 50 cents. So I put on the trade, I have my stop in 50 cents under from where I originally got in based on this dollar range. And as soon as I get 50 cents in profit, I will take off 1/3 to 1/2 of the position, say thank you very much, raise my stop now to my entry point. As soon as I get 1.5 ATRs or $1.50 from where I got in, I will take off another, let's say, 1/3 or 1/4 of the position or half of what I have left, and now I have my tail. And once I have a tail, that's when you can catch something that goes really parabolic. Now with that tail, I just don't let it go. I actually then start using other types of strategies with trailing stops. And I'm going to show you examples where I've gotten 10 or more true ranges at times the average true range before I actually got out of a trade. Okay, so what is the secret to this? I told you now that if you're trading something that's got $1, you're going to risk about 50 cents. But really, the true secret of it is that you want to have the same amount of risk on every single trade. I like to use about 0.5%, and this is very important, especially those of you who've gotten killed. I like to use about 0.5% of what my overall equity is in terms of risk. So, hence my 100K, nice round number, right? This way I don't have to think too hard. If I'm risking about 0.5%, excuse me, on a 100K account, that means on any given trade, I'm risking about $500. Obviously, if you're using only 10K, you're probably going to risk more, a little bit more like $50 to $100 on any trade. And that's all you really should when you're trading with that little money. So if something has $1 and I'm looking to risk $500, then I'm going to buy about 500 shares. Or, hold on, let me make sure that's right. It's late. No, I'm going to, actually, if I'm risking only 50 cents, I'm going to buy 1,000 shares. If I'm risking $1, I would buy 500 shares. So that's if something trades for $1, 1,000 shares. But let's say I'm buying something like Netflix, which has a $17 range. Now, all of a sudden, I'm going to buy 1/17 of this amount. So I'm going to buy a lot less. So what you really want to do is make sure you calculate how much you're willing to risk, that 0.5%, and then adjust your position size according to the range. Does that make sense? Okay. We're going to see some examples of that. So what that does is give you the equity curve and the smoothness of the equity curve that you saw before. This has been a tough year for a lot of traders. I'm up 8 or 9% in the portfolio just this year alone because, as I said before, I am absolutely hard, fast, religious about following this system. When I break the system is when I get into trouble, so I try not to do that. And this is why. If you stick to a risk-based system and you understand about 0.5% of your overall equity, you use your average to range to determine what your position size is, you try to take about 1/2 of that ATR risk when you're first starting out, especially if you're going to do a quick, take the first profit off at 1/2 an ATR, then all of a sudden all the stress goes away, or maybe most of the stress goes away, because emotionally now you've taken your emotions out of it. You're not doing what I said before, it's going, oh my God, I got it right, I can't believe it, or oh my God, I know it's going to come back. You take that hope, fear, and greed out of the equation. You don't get attached to the outcome because you already understand you went in figuring what you might lose. You also already know that it doesn't matter even if you lose 60–70% of the time. If you actually cut the losses quick and you have a good system, you're going to make it back. You have to believe in your system, obviously. And that all really helps me go to sleep at night without any stress at all. And especially, and I say this to you without, you know, I'm not jesting at all. I mean, I have several hundred people, hundreds of people who are trading what I trade. And I couldn't possibly go to sleep at night if I was sitting there worried about all of them every night and whether or not they were going to make or lose money. I really believe in this system, and you can see why. You saw that equity curve. It works. So the other great thing about it is that how do I know if I made a mistake? If I don't have some way to actually track my performance using this system now, I can. So I can see that, I'm getting chopped up a little bit. Maybe it's time for me to employ another one of my tools. Maybe it's time for me to step back. Maybe it's time for me to reduce my position size. These are all the questions that you can ask yourself when you actually are tracking your own performance using this system. And of course, what does this all do for you eventually? Helps you become a more consistent and definitely more confident as a trader. All right, well, this is just a couple of quotes. You know, essentially, yeah, I got a fan club, and it's great. This is what makes me want to get up in the morning and do this every single day. I love teaching. I love people. I love when people talk to me. I really feel great when people tell me that they've learned how to do something on their own. I have one person in particular who's been with me now for about a year, who never in a million years thought that she'd be able to do this. She took a shot, and I get, you know, basic love letters from her. So these are just a couple of people that have told me how they feel. And you know, as I told you before, when I went on the floor, it was just the goodness of people's hearts to kind of help me, a young new kid on the block. And that's how I feel about all of you, is that I'm here to give back because I really do love it, and because I know this is hard. Okay, so let's just do a quick review before we get into some specifics. So you're going to determine the phase: bullish, bearish, warning, etc. You're going to determine the daily chart pattern. Is it an inside day? Maybe on the evening watch list you want to find something that mentions an inside day. Then you're going to look at your intraday setup. You're going to look at your 30-minute. You're going to look for your best risk, whether it's a 30-minute OR breakout or what we call a 30-minute opening range reversal, which means it breaks down under the 30-minute OR and comes back through, giving you even a better risk. Then, as soon as you get money, a half an ATR, if you really feel the need to lock in, if you're doing a mini swing trade, that certainly is written into the program. And then you get to keep the money and be able to ride eventually the tail when you're right and really do very, very well. So let's go through some real trades. Excuse me, I'm just getting a sip here of water. Thank you. Okay, this is JO. I always look at this and go, oh, orange juice, but it's not. It is coffee. Now, futures traders, considering I spent most of my days trading futures, I now exclusively trade futures through ETFs. And so I came into this year with a mindset that I was going to be looking for opportunities in soft commodities. And this is no secret. Every year I write a pretty extensive phases and forecasts for the following year. And in this year, I was talking about looking at soft commodities in particular. And so as the year began, here's right here, the beginning of 2014, coffee had gone through a tremendous bear phase. So remember, this was the 200 right here. This is the 50 right here. A bear phase is just the opposite of what I showed you before for a bull phase. The 50 is trading underneath the 200, and the price is trading under the 50. So if you were somebody that liked to go short, you had plenty of opportunities to be short these soft commodities through the years. But I was waiting for the other thing to happen. I was waiting for them to bottom out. So as we came into 2014, I actually watched this go through, because I was watching it hold the 50 and start to move up. And then after it retraced, I literally waited to this day right here when it did, those of you who know what a hammer doji candle is, this hammer doji candle, and I got in on an opening range reversal that day knowing that I had a good risk against this 50-day moving average. And I immediately was able to take money off the table. Did I do a little bit of, oh my God, I can't believe I'm right? Oh, you bet I did, because I was really bucking a trend. And I couldn't believe it myself that maybe I actually did find the bottom in this thing. And by the way, this is a real trade. If you go to the model portfolio on the site on closed positions, you'll see it there. This is real. I rode this thing after taking some money off the table and even adding a couple of times all the way up. And then the story came out about the drought in Brazil, and I was like, oh my God, I can't believe it. Not that I'm happy to see drought, but the one really weird thing about being a commodities trader is you do sort of make your money when things are going badly, whether it be geopolitically or through Mother Nature, but that's another story. This 10-day moving average was accelerating to the upside so fast that what I decided to do was use a break of the 10-day moving average as my exit finally, and that's when I talk about an exit strategy. So what started out as a small little trade of maybe I'm right in doing it as a mini swing trade, maybe I'll catch a move to the 200, actually turned out to be something that I and all my subscribers made 71%, or 34 times the average true range. You see here it's at $1.23. That's not where it started out when I got into the trade. Let's go through another one. Okay, this is corn. I told you I was obsessed with commodities when I started this year. I've looked at them all: cotton, sugar, coffee, soybeans, corn. And I was really interested in the corn as well. And so again, like I showed you with coffee, here's the declining 50-day moving average, the 200. It was like way up here. You can see it coming in here, but it's off the charts in the beginning. Been in a huge bear trend for a long, long time, and I sat and waited patiently. I happened to be paying attention on this day right here because there was a crop report, and I thought, wow, that is really interesting. It made a new all-time low and then came shooting back to close well. So I waited because what did I want to see? What did I just teach you? Simple, simple, simple. Wait for something to cross a moving average. So I waited. I waited for it to cross the 50-day moving average. And I got in a little bit soon, right below the moving average. I got in at 30.97, but I liked my risk to under the low, about a half an ATR, and the 10-day moving average. Whammo, next day, half an ATR. Waited not too much longer to get 1.5 ATRs. I actually added to the position because now I was starting to see that I was actually right about finding the bottom in corn. And I will tell you that I'm still in this. I have a tail of this position, and I am riding this position until I see a certain level break. But at this point, having locked in a lot of money already, I've made 13% and about 6 ATRs. So those are my very explosive trades this year. It's a big part of why I've done so well this year, whereas a lot of traders came into this year focused on the same old of 2013. I had already moved on to look for other types of trends. Now, real estate is another place that I've been in and out of since 2012 when I saw the phase change back to bullish. And I happen to like Vornado Realty Trust. I've traded this many, many times. But more importantly, simple, simple, simple. Here's your 50. Here's your 200. Your price has been all over the place. And I waited. I watched it go up and down, up and down. Didn't really trade much at the end of the year. I typically sort of take it easy as we head into the end of December, into after Thanksgiving, really into the end of the year, knowing that market actually usually gets pretty choppy at that time. But as soon as we got into 2014, I actually missed the initial move. When I miss an initial move, do I chase? No. Remember what I told you before? Relative to where the moving averages are to one another, slope being up, I saw things look good. But am I going to buy all the way up here? No, I'm way too far from the 50-day moving average. I like to control my risk, and I was rewarded with my patience because it dropped down, and we got in at 90.01. At that time, the range was about $1.18. Next day, could take my half an ATR. It immediately started moving up. I got my 1.5 ATRs, and I kept the tail. I finally got out when it broke the 10-day moving average. And at that point, I had booked about 5.7% or 4.3 ATRs. If you are more of a longer-term swing trader and you want to use that 50-day moving average, you'd actually still be in this. And look where it is now. It still looks great. Okay, I like to go short. I'll go short with the best of them. But a couple of things you should know, that even though there are always going to be instruments that are going counter to the market, you still have to respect the overall market. And what happens with shorts, and boy, as a commodities trader, I certainly saw this in action, around one another. In that 1 second, I could see that everyone went, oh my God, there's no more sellers. And everybody would start to short cover, and you get those insane rallies. So I tend to, in a bull market, play for a true mini swing position when I go short. This is Time Warner Cable. So I wanted to trade a phase change to warning after it looked a little toppy here back in February. And so I waited very patiently for it to come down, chop around the 50-day moving average, and I could see that it was starting to show signs of weakness. So I got short on this day under the 30-minute opening range breakdown. And then, of course, the next day I got a half an ATR. I'm like, wow, this is great. I immediately started to move my stop shorts right now, especially in bull market. I tend to be much more of a short-term Momo trader. And then the next day I thought, wow, I look like a genius. This thing is really going to go down. But what happened is I didn't take any more profit, but I did trail down the stop to a break-even stop. So what does it do? It gets higher the next day. It opens up, and from where my initial entry is, I wound up scratching on the trade. So I didn't make 1.5 ATRs, I made a half an ATR, but more importantly, using that 50-day moving average, I was able to take money off the table. Had it continued to go south, I could have gotten a lot more out of it, but it didn't, and I didn't sit there waiting for it to go south. In fact, if you look at TWC now, it's back over this 50-day moving average. Now I want to show you how I lose money, but I want to show you that I lose money as intelligently as I make money, if that makes any sense. And that is, I don't like to sit around if I'm wrong, and I know I'm wrong. So there's a couple of things about this trade that might strike you. This is MBI. I'm kind of like, sometimes I get really sort of fixated on certain stocks. This one's been beat up for so long. I kind of saw the bottom. And then when this whole thing happened here, it went into earnings, and I never hold anything into earnings. I just don't. But I saw the golden cross right here. What is a golden cross? It's when the 50 crosses back over the 200. It's a very powerful time to be checking out a trade way up here. So I wasn't going to get involved all the way up here. So I waited and I waited and I waited, and I noticed, even though it's hard to tell here, that this was a gap higher. And so in the last week or so, I saw it was holding that gap. I'm still really far from the 50, so I was not going to do this with a tremendous risk. I could have if I were that kind of trader, but I wanted to be more, see if this thing had any kind of juice to go up with the market starting to go up. And I got long against that gap low at 1407 on this day. And it didn't go anywhere. I waited a couple of days, and finally, when it broke down, and you can't really see it here, but when it broke the low of the day before, I got myself out at 1377. So the ATR on this is 35 cents. I lost about an ATR on this one, but I had position size very small, so the loss was really nominal, and really basically, as I said, could I have waited for this to head down to the 50? Yeah, but I didn't. I wanted to give it a shot, but even given a shot, I stuck to the strategy almost religiously. All right, so now let's look at something that's in a completely different kind of phase. I've shown you bullish, I've shown you warning. Let's take a look at something that's actually going, and I showed you recovery with the two commodities. Let's look at something in an accumulation phase. Accumulation phase is when the 50 is underneath the 200 still. Recovery is when the price crosses the 50. Accumulation is when the price crosses the 200. This is oil. Also very, very much on my radar this year because, again, it's a commodity. And so when it broke over the 200, look at what a beautiful risk I had on this day. I could get in knowing that I could risk to right under where the 200-day moving average is, and pretty much I waited just a couple of days and I got a half an ATR. And then it gapped up, and I was really excited because I got 1.5 ATRs. And I kept a tail, and it kept going. And then, those of you who have more experience, I saw this. I've even been writing about it in my daily, an island top. So I knew things were probably not going to be as good as I thought they were going to be when I first got in, but I already booked 2 profit targets. So I had just a tail, and I used what I like to use very often is after the gap lower, I waited one more day just in case it would fill the gap the next day, and I had that cushion and a very small piece left, and then I exited the trade underneath the 10-day moving average. Now I will mention that sometimes you get 2, 3 opportunities with any given instrument because the phase changes a lot. You can see this went back down into a recovery phase, back to an accumulation phase. Now it's back down into a recovery phase, and actually today it closed under the 50. It's actually back in a bearish phase. But really what you want to be looking at is the position of the moving averages and when they start converging, because that is what I call an inflection point. This is a trade I'm still in right now. I've taken 2 profit targets out of it already. This is Hospira. Again, I want to show you that I like to buy, I'm happy to buy in a bullish phase, but I really, really enjoy buying when I see a phase change and then a major moving average hold, and I get my low risk opportunity. Now I have been in and out of Hospira also. I tend to like to buy the same stocks over and over again, especially if they were part of my analysis as having great potential for 2014, as I believe this one did. And so we were finally out of it when it broke down under this into a warning phase. Look at the slope. The slope really stayed pretty good, even as it was breaking down in the 50, and certainly in the 200 it stayed very strong. So on this day, It broke down, made a new low, came back through the 200, and I was able to get in at 41.27. It was an opening range breakout because this all happened in the morning against the 200-day moving average. I had a half an ATR of risk, and then whammo. In the same day or within 2 days, I was able to get a half and 1.5 ATRs, keep the tail. I took a little bit more off actually yesterday at 3 ATRs, and I'm holding my tail on this one as well. And I see your questions coming in. Hold those questions, I'll come to it later. Now, this is an older trade. This one happened actually in the fall. But Jeff and I decided that we should include this because I really wanted you to see that in 1 month, we were able to make 12% on X, which is U.S. steel. Again, commodity. I've been very commodity minded this year and to the end of the inflation phase. We entered at 2068, so that was down in here. And then you can see 1.5 ATRs. We left the tail. Now, I did exit this day right here. This was right before earnings. I exited before earnings. I could have gotten back in after a couple of day correction. I didn't. I was on to different trades at that point. But I just want to show you another example of how you know, a good phase change could lead to something like this. VLO, this is another commodity. Essentially, with this particular one, I waited for that recovery phase. So you see, I tend to be an anticipatory trader. There are plenty of people out there who like to buy new highs and go with the acceleration and momentum, and that is a legitimate way to trade. My personal style tends to be a little bit more conservative, but that doesn't necessarily mean that I make less money than those guys. It just means that my risk is more conservative, because if I anticipate correctly, I get a great return, and if I anticipate prematurely, I lose just a small amount of money. So here we got in here. I anticipated the phase change. Again, I like to anticipate. Got in at 34.56. It went the next day to 1.5 ATRs. I kept the tail, and then I exited again on this one. Probably this was right in the earnings season, and I exited it before it reported. But this is another one that's still looking pretty darn good because it's in the real estate sector. Now, I told you before with USO and certain things I like to get in a couple of times. I'll take my profit off the table. If it gives me a reason to get in, it gives me a reason to take my profits and then reason to exit, but I'll keep my eye on it. This is GDX. This is a gold mining stock. Okay, again, very commodities driven I have been this year, but it doesn't matter because this works with whatever, and I've traded plenty of other stocks besides commodity stocks. I'm just choosing to show you these today. But what happened with this is it had already taken out the 50-day moving average, and I could see the slope was really starting to accelerate. So I got in after it gapped up on this day, and I used the gap low as my stop. Certainly I wasn't going to stop here. So if I have another reason for a tight stop, I'll take it. And again, I was very excited to see that it actually took out the 200. I was right. Got a half an ATR, 1.5 ATRs, and then I thought, this is running out of steam. So I got out of the rest of the tail, but I still made money. Then I actually waited, chopped around. I got back into the trade on 311 at 26. I waited for it to hold the 30-minute opening range low, got in, once again got my 1.5 ATRs, and once again exited when it broke down the 10. Now, this chart actually right now, if you look at this today, it's trading up here. So just a little freebie advice. Keep your eye on this if it's going to get back over those moving averages, the gold miners. Now, I just want to show you what this looks like. People said, how do I use a 30-minute OR? I did see that question got in. So this first bar, this is 30 minutes. This is a 30-minute chart. I use 1-minute charts, 30-minute charts. I use weekly charts, monthly charts. I use different moving averages for all of them. I do not use any exponential moving averages. I used to. I really find that I have been much more consistent using the simple moving averages, and I use pivot points, as you can see here. So when they all line up, that's when I go in. So in this case, we got in at 24.45. As I showed you where we took the tail. So again, when we got in the second time, I did the same thing. I used the 30-minute opening range, and if I decide just to go back here to get back into this trade, it will be because I get a good spot, let's say above the 200-day moving average with a good tight risk, using either a 30-minute opening range breakout or reversal, again with about that half an ATR of risk. And by the way, I say half an ATR, but obviously you know, that's a guideline. Sometimes it's a little more, sometimes it's a little less. So now you can see that if you just wait for 50 and 200-day moving averages, if you wait for the price to be as close as possible, if you can look at a 30-minute opening range, time your way in, assess your risk, know how much you're willing to lose, and then get out at those increments I showed you, pretty much in as soon as a week, there will be stuff setting up if you're very, very careful about what to look at and try not to get too fancy if you're just starting right out of the gate. And if you're a more experienced trader, if you just sort of fine-tune the type of strategies and things that you're looking for. Patience. That's my number one thing is I'm an extremely, after doing this for so long, I am an extremely patient trader. If it isn't set up the way I like it, I don't sit there and go, oh, darn it, it went up and I'm not in it. No, I go, hey, it wasn't set up the way I want it. I'm going to wait for the one that is. Just as gratifying to do that and a whole lot less stressful. So I see all your questions. Jeff's going to come back on. I'm going to go get some more water. I'm going to come back to you and we will go through the Q&A, and I will give you a couple of trades to look at tomorrow.
Okay, thanks, Mish. So you're going to go grab your trades, go get your glass of water, and I think everyone should be seeing my screen right now. They are. All right. So you've just seen how Mish trades. All the setups that she did or trades that she's taken, a lot of them were phase transitions, which is one of her favorite setups. A lot of your questions have to do with how she times her way into those trades, and as you can see, her daily approach is very systematic. Her intraday approach to selecting those stocks is just as systematic. But in 50 minutes that she's got to do the presentation, we can't get into it all. But I think you should be able to see how easily repeatable that it is. And you can see how she makes managing risk and figuring out targets as easy as understanding what average true range is and what you expect to risk on each trade. Hello? You didn't lose me.
Jeff, you there?
Yeah, I'm still here.
Hey, should I go do the couple of trades
Yes.
I was going to give?
Yes, change presenters. I'm just going to answer one more question as you change the screen.
Okay.
Brad's asking, can I trade this systematically with Delta 70 options? You absolutely can. Now we don't recommend particular option trades, but we do have plenty of subscribers and members who trade options. So because we are such a directional approach to the markets, if you trade options in a directional fashion, it'll work.
Okay,
all right,
so
go ahead, Mitch.
all right. This comes from my evening watch list tonight. Both of these trades. I'm going to give you one short and one long, and that's for my skeptic who thinks I only make money in a bull market. I even make money short in a bull market, if you understand how to do this. So the first one is, though, from the long side. This is LNC, Lincoln National Bank. I mention this for a couple of reasons. Number one is on a phase. Obviously, we're in a bullish phase. You can see that the 50 is above the 200. The price recently tested that 50 and it held. Number two is I happen to think that the financial sector, looking at the macro picture, has potential still to the upside, regardless of what happens with the interest rates, unless, of course, everything skyrockets in rates. That's another story. Number three is that, remember I told you about short-term trading patterns and what I look for. In this particular case, coming off the 50, bouncing, we had an inside day today. Remember I showed you that an inside day is when the range of this day is inside the day from the range from the day before. The risk to the 50 is certainly legitimate, but for our purposes a bit far. Because it's an inside day, I know that I can risk maximum would be to the low of yesterday, even the low of today, depending on where it comes in tomorrow. So that means if this sets up tomorrow, the fact is that it had a nice day, across the 10, if we're trying the day before and failing, has an inside day range. We break out of the inside day range. I can choose my risk depending on the market, or choose not to go in at all depending on the market. But if it sets up on an intraday pattern using a 30-minute either reversal or breakout, depending again on what the market does, I would say that you have a risk to here. In fact, I will read to you exactly what my instructions are. Inside day over the 10 DMA has to hold today's low and clear 52.09, which is above the high from here, in order for you to get a target of 58. So you may be wondering, and by the way, options traders, that's how my options traders trade, is based on not only my stop parameters and my entries, but where I look for targets. How do I know this is going to be a potential target of 58? This is where I start to use some of my other charts. Here's my monthly chart. I have a Bollinger Band coming in at around 58. My weekly chart's a little less, so we might have a little resistance here up at the highs from 2014, but it would still be a good trade regardless, because if we did it as a mini swing trade, we'd still be able to get that half an ATR and go to the no loss stop and see if it can continue going. So that is my look-see for tomorrow on the long side. On the short side, this is Monster Beverages. Okay, so basically what's happening, and you can see, remember I told you I use a volume. So here's my volume. It's not spread out very well, but I use two different types of RSIs, a regular 2-day RSI. On the daily, I use a Bollinger RSI, but again, I'm not going to explain any of that to you right now. But I will tell you that Monster on the short side is a potential. Why? It made a peak high here. The 10-day moving average slope is starting to decline. It's up and down around the 50-day. Today, it broke the 50 with another inside day. Let me spread that out for you. I love that inside day when I see it. So here's an inside day to yesterday's range under the 50. That tells me if it breaks down under these lows, with a little bit maybe fudge of breaking down under the 10, you probably have a good risk here, $1.39 average to range to the 50-day moving average. If this continues south, you can get some support down here around the lows from January, February. Otherwise, if it really deteriorates, you may even see a move down to the 200. My exact words to my subscribers: Monster inside day shouldn't clear 70.60, and if it fails 69.10, could see a move to 59. So there you go. Those are my two trades. So look for Monster short and LNC long.